Okay, we're back with part 2 for these videos that are being used for purposes of some enriched learning while the Jewish holiday occurs this week. The good news about this one is this is the actual last part of Chapter 1, as we shall see. The bad news is it's a little complicated, but I think I'll be able to walk you through it, and you'll be able to at least perform what you need to do for Chapter 1 when we get to intra-company inventory transfers at consolidation. I've got another shortcut method for that, even though it's conceptually difficult to imagine. The shortcut method will at least help you through the problems. We'll again try to address the rationalization of what's going on when we get there as well. We're going to do it here to start, but if you don't quite get it, then stay tuned for when we get to it later on in the consolidation. All right, the textbook doesn't do such a bad job on it, so you might want to check there. And basically what the textbook describes is the following situation. A company, which is obviously the parent type company, and B, the investee company, so this is the investor, went on an equity method arrangement because A owns a significant influence but not consolidation amount yet. A is performing equity method for the investment it has in B. But as we learned in class, these mergers, acquisitions, these purchases of stock, these investments at this level, when we're getting in equity method, they're often made with business purposes in mind. So the example the book uses is that A is selling inventory to B. It could also be that B is selling inventory to A. Works both ways. And they call the two different arrows, this arrow and this arrow, by two different names. This particular arrow here is called a downstream sale of inventory, down from the parent to the smaller or subsidiary company. And this particular one over here, where the arrow goes this way, the sales of inventory from B to A, they're going to call that, you guessed it, an upstream sale of inventory. And the concept is that because of the relationship between the two companies, until the inventory is actually sold to an outsider, meaning between A and B, if the inventory is only in between the two companies in this one circle and not sold to an outside person like me, then the profit on the sale is not supposed to be recognized, at least to the percentage of the equity method holdings. Let me say that again, because that's the whole key here. When the inventory does not go here, the profit is not recognized on that inventory until sold to an outsider, meaning this guy. So that means that intercompany sales, we don't recognize the profit on those until it goes here. And the book example continues. For example, what the book example will do is the following. Let's see if we can do it over here. The book example has A selling to B, which at this point you should say, that's downstream. So practice saying that. I can hear you if you're saying it, so I'm not hearing you too well there. This is a downstream sale. And the way it worked is the sale was for $50,000 from A to B of inventory at a markup of 30, well, not a markup, but a gross profit percentage of 30%, meaning the profit on the whole thing would be 30%. But at the end of the year, only $40,000 was sold to that outside stick figure, sold to outside. So we'll just say sold to out. That left $10,000 in the inventory between A and B. Now it happens to be that this $10,000 inventory left was on B's books because B bought from A. That's important to recognize. That's what's happening. But the real thing to recognize at this point is that how do we get rid of that? Let's do that. The important thing to recognize at this point is that between A and B, this $10,000 inventory has not been sold to outsiders. And the 30% gross profit recognized on A's books in the sale to B is not to be recognized on the remaining inventory until the remaining inventory is sold outside. The remaining inventory in this case is indeed just the $10,000 that hasn't been sold to the outside. And so that's what the textbook is concerned about. And the way the textbook does it, I think we need a new, more fresh sheet, so we'll look here and find it. We'll come back to this. The way the textbook does it is it says, all right, you got $10,000 in ending inventory. Now remember, the gross profit has been recognized on A's books because they sold it. And on their books, they recognize the profit. B hasn't sold it to the outside stick figure yet. So of this $10,000 amount that remains, we have to pull out of earnings the 30% gross profit that A recognized on its books. So the 30% gross profit was $3,000, but the equity investment in the book, if you look at the book example, was only 40%. So it's only 40% of this amount. Remember, we're on the equity method, so it's based on the percentages. So 40% of that comes out to $1,200, and that's what we're going to pull it out. The journal entry to do that is just simply pulling out an income under the equity method, which would be equity income. That's again the textbook approach, equity income in investee. And you should be able to figure out, even without looking, that this is the debit, which will be $1,200, as we can imagine, and the credit is the investment account. So you're simply reducing the income by the amount of inventory not sold to outsiders. The good news, if there is good news, is that this entry is the same regardless of whether the sale is downstream or if it is upstream. You do the same calculation, same adjustment. That's what you do. The bad news is we're not finished yet. Good news, bad news. And that's because one thing. It's true that at this point, this is recognizing the inventory not sold to the outside stick figure yet that we drew before. But next year, in year 2, that inventory is going to get sold to the outside person. This time, the person's nose and mouth and eyes are even worse than they were before. But this outside person outside of A and B will be buying that remaining $10,000 inventory. Now they're going to buy it at some maybe further profit. Who knows? That's not the important thing. We don't need to worry about that. All we need to know is that that means that this year 1 adjustment here, where we held back the recognition of that inventory not yet sold, has to be reversed and recognized in year 2. So the entry is simply a reversal. Year 2 will be, like you would expect a reversing entry to be, the opposite of what you have. So in year 2, you would debit the investment account by the same amount, $1,200, and credit equity income, which is the income account. Again, don't let the word equity fool you. Equity income account in investee. Same $1,200. This is the credit. That's a debit. Just reversing what was done before. So, good news, bad news is even if you don't understand exactly why we're doing what we're doing, take a look at the book and just follow that approach. Do it like a cookbook, hoping that when we get to this same intra-company sales of inventory with the consolidated, then you follow the logic a little better. But I think we've done a pretty good job of explaining the logic, and the logic is simply that the inventory has not left the combined A-B group. Remember, this equity method is having A mimic B's retained earnings, or equity section. And if it's doing that, it sort of combines the two together, recognizing its income, recognizing its dividend as a reduction of the investment account. So in order to be fair, it's taking A and B as if it was a group together by itself, just for the percentage of the equity method amount, just for that percentage, that X percentage. And so the same concept would be for any intra-company transactions, they should be held off until they go outside the box, or in this case, outside the circle. All right, that's really the last topic of Chapter 1, and maybe the more challenging of the two. And I apologize, but I'm just the messenger here. Last parts of the, well, let's see what they say here. Here's a slide explaining it a little bit further before we finish up Chapter 1. Deferral of unrealized profits in inventory. The seller of the goods retains a partial stake in the inventory for as long as the buyer holds it. That's A in our example is the seller, B is the buyer. It could be reversed if it's upstream. A to B is a downstream. Remember that. The earnings process is not considered complete at this time. I think I did a job of explaining that to you until the stick figure, the outsider, gets it. So reporting the profit is delayed until the inventory is consumed within operations. That's one way. Or resold. Typically, the problems will have it resold, so you don't have to worry about consumed with operations. It's typically the problems will do that they'll be resold. And we make the assumption, by the way, that it's always resold that second year. That's an assumption. That's what GAAP does. GAAP gets away from trying to figure out when it actually sold. Assume sold year 2. That's always what we do. It just makes life easier, and life goes on. At the disposition of the inventory, the original sales culminate in gross profit is recognized, again, knowing that we always assume it's in the second year. All right, that completes the inventory, I believe. And the rest of the chapter is devoted to the effects of doing the equity method, both good, bad. And what I would do is, I'm not going to go through that here, or maybe I might point out one or two as I flip through the remaining slides of Chapter 1. But really a great test for you is if you can read that, I would call that critical remarks about the equity method. If you can read that part of the chapter and say, oh, I understand why it's a criticism, or I understand why it's considered to be good that the equity, of way the equity method is working. If you can understand the remarks, both pro and con, then it's showing that you have a pretty good understanding of what's going on with the equity method. So it's a really great way of testing your intellectual understanding of the equity method. May not do you a whole lot of good for the problems on the test, but it should. But so I'm being a little facetious there, but it definitely would show you whether you've digested the concept of the framework of using the equity method. So just going through the slides to see if I want to point out anything in particular. Yes, all this is true. Why? That's what I want you to answer. Why is all this true about the equity method, both pro and con? Yes, this is, I think everyone can understand that what probably happens in the real world is everybody just says if you're in this range, you do equity method, and people don't start thinking on whether there is significant influence or control. I just had this in the office, by the way. I was reviewing an audited financial statement, and the staff accountant manager brought it to me, applied the equity method for a 20% investment. So I said to him, well, did you analyze if there was significant influence? And he said, no, because it's 20%. That means equity method. That's what he said to me. And I said to him, well, go back and look at GAAP and see what GAAP says. And sure enough, in this case, that 20% is not significant influence. The way the deal works is that even though there's a 20% ownership, they have relatively little rights. They're not on the board. They're not in the management. They are simply just a pawn. And so I took issue. I'm still dealing with it in my office. I'll let you know how the battle ends up, but I'm still dealing with the fact that I think that they need to adjust their financial statement. Needless to say, I was not one of the most popular partners in the office this past week. Well, so goes the territory. Okay. All right, back to the critical remarks here. So you might want to take a look at some of the. This is a good one, and we really should. Somebody really should try to address this. Maybe I can give this as like a bonus points for someone answering it. Though I know it's probably in the chapter, but this would be good for you to understand why this is a critical remark of the equity method. And this is not a bad one either, although almost anything out there in GAAP land is open for manipulation at times. Okay, let's see. Here we go. Let's see. The fair value reporting option. Really, that is the last part of the chapter, but I'm not covering it in this course. I don't believe I'm going to show any of the questions from the test bank on it, but you should know it. It really was supposed to be part of Intermediate 2, I believe. And what it is you make an option. You elect, so to speak. You elect to apply fair value for certain financial assets and financial liabilities, including, that's the key word, equity method accounts. And so what happens there is changes in the fair value is applied to even what otherwise would be equity method investments because you've elected to do the fair value. And that's it. Very good. I'll be back with more on some of the problems.